Let's start with the hardest working economist in insurance, an NCCI alumnus, former head of the Insurance Information Institute, and now a professor at the University of South Carolina. Let me introduce our friend, Bob Hartwig, with his unique take on the workers' comp and insurance landscape. Welcome, Bob.
Thank you very much, Bill. My pleasure to be here, and my pleasure to be able to speak to all of you today. We have a lot to get through. A lot has happened over the past year. As we all know, you had the wonderful presentation from Donna Glenn today. I'm going to bring you another analysis based on the economic situation over the past year or 15 months or so. And we'll begin with a discussion of the economic scarring that has taken place. There's no question about it. We're all seeing and feeling the scars of COVID-19, both physical and economic, even today. And they're going to continue for quite some time. And there have been a lot of impacts on the P&C insurance industry, of course. So we'll be talking a lot about what was predicted a year ago. There's quite a lot of doom and gloom a year ago, and we'll see what has really turned out to be the case. And you did hear some of that from Donna yesterday, and we'll follow up on that with some additional details about what's happened to the industry overall. There's been an enormous amount of labor market dislocation, of course, and that is ongoing today, and that will actually be ongoing for several years. It's going to be a very interesting time to watch. And of course, over the past year, we have seen any number of very large federal stimulus programs passed by Congress and put trillions of dollars into the pockets of workers and into the coffers of businesses. And we'll see what the impacts of those have been, because all of those, of course, have helped to maintain payrolls and business activity overall. So it's important for the P&C insurance industry. And we'll conclude on a discussion about what is the appropriate role of government in the appropriate role of insurers in terms of managing the economic consequences of pandemics. It's a very dicey issue today. So let's get right into some of the economic scarring that I mentioned at the onset. Some very deep scars. Now, when you take you look at it right away and you say not much seems to have happened in terms of the impact on overall industry profits. We went from about 62 billion to just under 61 billion in 2020. So you could argue the impact wasn't all that large, though this did result in a reduction in the industry's ROE from close to 8% in 2019 down to just below 7% in 2020. Now, this is below what most people had predicted. Historically, an economic downturn usually winds up driving down ROEs by 4 or 5 points. So it was something much less than that. In fact, that is a common theme that we'll see, that ultimately what turned out to be the case from COVID, at least to date, the impacts on the P&C insurance industry were nowhere near the worst case scenarios that were being envisioned a year ago. Now, in the first quarter of last year, we did see a very substantial 9% drop to the industry's policyholder surplus. So we're talking about tens of billions of dollars. We didn't know when we were at AIS in 2020 that we would not only make that up very quickly, but reach new record highs by the end of the year. That was truly extraordinary and unanticipated. We saw premium growth last year drop to about half of what had been expected. We certainly expected that, but it wasn't as bad as it could have been. AM Best, prior to COVID, had predicted growth of about 4%. It wound up being, across all P&C lines on a net basis, just under 2%. So not really bad at all things considered. The expectation actually is that with the economy recovering next year, we'll see growth closer to 5%, which is some of the strongest growth we've seen in quite a while. And I think one of the most remarkable results of all is, in fact, the industry's underwriting performance. Prior to COVID, the expectation was that the combined ratio would be about 99.1 in 2020. The actual was around 98 or 99. In fact, there seems to be no discernible impact from COVID at all. But what you have to do is step back from COVID, which really dominated the headlines last year, of course, and realize there was a lot going on in the P&C insurance industry besides that. In particular, it was a year of very, very heavy cat losses. So some of the exposures that we saw lost as a result of COVID, which resulted in a net improvement in the overall results, quite frankly, were actually offset by a very heavy cat year. And so, but that was kind of overshadowed by COVID itself. Now, speaking of some of the scarring, we have had some of the most erratic economic activity that we've seen literally in the history of the United States. As we were here at AIS 2020, the economy was contracting rapidly. In fact, contracted by nearly a third in the second quarter of last year before bouncing back by a third in the third quarter of the year. And where we are right now, we are actually looking, and again, this is something we absolutely could not have anticipated a year ago. We are actually looking at 2021 as being the strongest growth year for the U.S. economy in 40 years. In other words, since 1984, and the second strongest year since 1955. So I think, again, talk about unanticipated consequences of COVID. This is certainly one of them. Now, I've always been a believer in the V-shaped recovery, and I always thought V stood for vaccine. But quite frankly, this economy is taking off faster than even I would have anticipated. Now, we've had, of course, enormous fiscal stimulus associated with this. But the other part about that is the Federal Reserve has been very accommodating and interest rates have been driven down very rapidly. You could see that in terms of shorter-term yields in orange. We also saw that in terms of the 10-year yield. A year ago, when we were here, the 10-year yield was actually plunging, and by July, it was down to about 0.6%. It's close to where it was prior to COVID right now, but interest rates are still very low by historic levels, and this is pushing down the overall yield on P&C insurance industry invested assets. And in fact, last year, we were very close and perhaps even hit the lowest return on the P&C insurance industry's invested assets that we had seen in 60 years, since 1961. So again, truly a historic year. Now, this is a problem for the P&C insurance industry, not just this year, but for the long term. Even with reinflation and some higher interest rates expected maybe in the years ahead, the Fed has vowed to keep interest rates low at least through 2023. And so this is going to suppress the overall industry's ability to generate investment income. And you can already see that in the data with investment income last year down to maybe about $52 billion from about $57 billion the year before. And so we would expect to see that continued pressure on investment income really for years to come. Now, if we move along from that, we're still talking about economic scarring. I'm going to talk about the scar that no one wants to talk about right now. We've spent an awful lot of money to dig ourselves out of the COVID hole, and you can have a political debate about how much of it was justified and how much was not. But there is an appropriate role for government at times like these. And what we have done, of course, is most of the spending that we've seen over the past year has been a deficit spending. And so we have driven up the national debt to nearly $28 trillion with a T. So trillions of dollars being added on just in the past year. And the nation's debt to GDP ratio now is the highest it's been since World War II. So at the end of the day, large deficits like these, at least as a share of GDP, are at some point not sustainable, and they are ultimately inflationary. And in fact, we are beginning to see that now. We are looking at inflation in 2021 based on the latest numbers, which actually just came out this morning. We saw prices rise by 4.2% for the 12 months ending in April. And the expectation is for this full year will be at about 3.3%, followed by 2.6% next year. So you can see that's the highest we've seen in about a decade. The whole question is whether or not this is a transient surge in inflation or whether or not it becomes embedded and spreads throughout the economy. You are seeing it in your daily lives right now, whether you go to the gas pump or whether you're trying to buy a new used car, you are seeing it. But there are real implications for insurers, the most immediate of which would be rate adequacy and reserve adequacy. And we'll talk about that in a moment. But if you look at overall inflation numbers, these were for March over March. You can see energy up 13%. Again, you see what's happening in terms of if you can get gas at all right now, the price is rising quite rapidly. Existing homes up 11%. Our friends on the auto side and on the property side are already getting hit quite a bit. For instance, used cars up 9%. In fact, the new numbers that just came out this morning showed an increase of 10%, which is the highest number for used car price increases since the data go back all the way to 1953. So some extraordinary inflation building in certain segments of the economy, but not all segments of the economy. So it hasn't become quite as widespread as it might ultimately, but we're still in early stages of this economic recovery. So why do I think that inflation is something we are going to have to contend with as an industry going forward, potentially for the next couple of years? The first of all is a huge policy shift on the part of the central banks around the world, and particularly the Federal Reserve here in the U.S. quite frankly, they're less concerned about inflation. Over the past year, they've had a dramatic shift in terms of their policy goal. The shift now is for full employment, away from price stability. So for decades, beginning in the 1970s, the Fed's focus was to keep inflation tame and under wraps. Right now, we've shifted to full employment. So the Fed is going to allow inflation to run a bit above its 2% target, potentially for years, before it may actually wind up raising interest rates. Okay, so that's a huge policy shift. Now, politicians, as you have probably observed over the past year, and really dating before the most current time, is they have shifted to a spend now and pay later philosophy, or pay less later philosophy. And so neither political party today has the political will or the incentive to finance their spending. Let's face it, stimulus checks are very popular. Taxes and austerity are not. End of story. You don't really have to go much beyond that to understand what is happening today. So much greater tolerance for inflation, both in terms of monetary policy as well as in terms of fiscal policy. The other thing that I think biases us toward inflation is the fact that we have an enormous number of supply chain disruptions today. We have found that the economy is very fragile as we are awakening from what I like to refer to as the COVID coma. Again, you need only visit for instance, your local gas station today to see something like that happening. But if you take a look at, for instance, what's happening in areas outside of this, you look at motor vehicles, plants shut down because there are no chips to put into these vehicles. For instance, transportation, supply bottlenecks all over the world, impacting everything that we consume. And then first and foremost, most important for workers' comp is labor. To the extent that there is not an expansion of the labor force to the extent that we need it, this is going to hold back workers' comp exposures. And longer term, I'm concerned about a lot of geopolitical obstacles, but that is for another presentation. Now, as we move forward into some of the more direct implications for workers' compensation, I do want to remind you that you do have the opportunity to ask me questions directly about what I'm talking about now, or what I'm going to be talking about in a few minutes as I dive into a few other issues. I'd be happy to take your questions, and we'll have at least 5 minutes for that at the end of this presentation. And I'll offer a couple of reminders later on as well. So just be thinking about that and type those in. Now, I am expecting a modest uptick in inflation, with bursts of inflation in certain sectors, which are really going to impact many consumers, including lower income consumers in particular. But again, I mentioned our friends on the property side. If you are a personal lines insurer covering losses from the major catastrophes or what is expected to be an above-average hurricane season in 2021, you are looking at a 130% increase in the price of lumber. They might argue it has very little to do with workers' comp. But what I'm saying is these costs are beginning to seep into the P&C insurance industry. I got a call from a CEO of an auto insurer just earlier this week and told me how it's almost impossible for them to get parts or to buy used cars for clients whose vehicles have been severely damaged or destroyed. So the cost of a home, for instance, is up about $24,000 on average. So these inflationary expectations are gradually becoming more and broadly embedded throughout the economy, and this suggests an acceleration in price inflation is somewhat more than transitory, though it does fall short of permanent at this point. So it's going to spread to other sectors. This will likely lead to wage inflation. In fact, it already seems to be. This will impact indemnity severities, and medical inflation will also eventually be impacting medical severities. And of course, we know that medical costs are always challenging to contain, even in the best of times. So what this means is that reserve and rate adequacy could be challenged for the next couple of years throughout the P&C insurance world. And I'm looking particularly at workers' comp, property, and auto, both commercial and personal lines, where there are going to be some concerns. And I expect insurers are likely going to be reacting to that relatively quickly. So I wanted to get into the discussion now about how have actual P&C results differed from what we expected a year ago. They've differed dramatically. Let's just take a look at workers' comp. And I know you heard Donna talk about this yesterday, but this is a prediction, and it was echoed by many others at this time. This came from Willis Towers Watson, which predicted in the area of workers' comp, for example, we would see a decline in premiums written of between 12.5% and 25%. That translates into about $6 to $12 billion. And in fact, as Donna discussed, we saw nothing really like that in terms of the drop-off. It was a significant drop-off, but not as significant as has been predicted and nowhere near the worst-case scenarios. We did see some drop-offs in some other lines, economically sensitive lines, such as $10 billion or so for personal auto with refunds there, and marine transportation, aviation, those sorts of things, seeing some negative premium impacts as well. But when I put it all together here, looking at what happened in 2020, the biggest decline was in workers' comp. That should come as no surprise to anybody, given the fact that workers' comp is arguably the most sensitive to the economy of all major P&C lines. But inland marine, where we're dealing about a lot of transportation on vehicles, for instance, and infrastructure, spending was way down on that. Private passenger auto was down a bit with the refunds. Not a lot of driving going on the commercial auto side, at least for a while. That was depressed. But we did have a hard market going on in commercial lines, and that is why we actually saw fire, allied, other liability, and a few other lines have pretty substantial increases despite the slowdown in the economy. And homeowners also was up, again, because of strong rate in that area, driven largely because of catastrophe losses. Now, in terms of losses themselves, the predictions a year ago for what the losses, insured losses might be in workers' comp were extraordinary. The range went from about $200 million to $92 billion. Could you imagine if the losses, insured losses, had actually been $92 billion to workers' comp alone? It would have been certainly, we'd be having a different conversation today, just to say the least. But it was much closer to the low end, of course, and that's very good news. And obviously, some insurers that had no exposure to certain areas like workers' comp saw little or no impact from COVID, at least on the loss side. But the estimates were all over the place a year ago. Quite literally, we saw estimates ranging from as little as $11 billion in terms of global P&C COVID-19 related losses, all the way up to $140 billion. You had Lloyd's, for instance, estimated global losses would be around $107 billion, that there would be huge and lasting investment losses. So thankfully, these worst case scenarios did not come to pass. And in fact, much lower, but that doesn't mean that they're not, the losses were not consequential. They were. But I think one thing that most people are not aware of is that the lion's share of the insured losses from COVID occurred beyond the borders of the United States. And in fact, they wound up on the books of foreign insurers and reinsurers. Now, some of these losses were no doubt ceded from U.S. reinsurers from U.S. insurers to foreign reinsurers, but nevertheless, what you see here is leading the list. If you look at Lloyd's, Swiss Re, Munich Re, AXA, so we're talking about, UK, Switzerland, Germany, France, Germany again. You have to go all the way to Berkshire Hathaway, about sixth on the list before you see the first U.S. company, followed by Chubb. But the majority of the companies here, and this is just a sampling, are foreign. The top 11 U.S. insurers, the list I had compiled from various sources, had about 60 insurers. Only 11 of them were U.S. insurers. Again, there are many smaller insurers that would be on this list if we took it all the way down. But breaking it out that way, we see Berkshire Hathaway leading the way in terms of insured COVID losses. Again, the total of these 11 U.S. insurers came out to about 20% of the U.S. total. And it breaks down this way. So you take a look at Europe, excluding the U.K., about 46% of losses. UK, about 1/5. That includes Lloyd's. You got Bermuda at about 5%, Australia at about 5%, and the U.S. about 20%, and then very little anywhere else. So I think these results are very, very interesting. And so in some ways, the Europeans had a much more difficult time managing COVID-19 related losses than we did here in the U.S. And that has a lot to do with the fact that the way that business interruption is handled in Europe is fundamentally different than how it is handled here, and how the courts are treating the system is different there than how it is being treated here. So why did the worst case scenarios for COVID fail to materialize? First of all, the economy recovered much more quickly than anticipated. It really was a V-shaped recovery. Rapid financial market recovery. So those losses that we saw to policyholder surplus did not linger, and we actually reached new highs. Massive government stimulus beyond anything that I think anyone could have imagined. The worst case epidemiological outcomes, in other words, the pace of the virus was avoided in large part, or to a very significant extent, because of the record pace of vaccine development. And quite frankly, a fantastic job on the part of many companies in terms of risk management who did a good job of protecting the workers from exposure. And you saw that in the workers' comp numbers. Those numbers were were right around the very lowest end estimates that we had a year ago. So it's a tribute to this industry, and it's a tribute to the employers out there who did a fantastic job altogether, when you take a look at it, of protecting their workers. By the way, many states, as you know, didn't repeat their spring lockdowns, spring 2020 lockdowns, so that wound up helping the economy out a bit. And then a very big important point that differentiates us from Europe is the litigation outcomes on business interruption have generally favored insurers in the United States, at least to date. That litigation isn't over, but at least to date. And the workers' comp presumption expansions that occurred in the early part of last year did not lead to the explosion of claims I think that many feared. And there were also very significant offsets from many lines. Reduced auto claims, for instance, it was a very important factor there as well. So now I want to move on down to my list of the important issues and the scarring that has occurred, because the labor market dislocations that have occurred, again, you heard some of this from Donna yesterday, are going to linger for years. So what this chart shows is the historical relationship, really since the beginning of the financial crisis in 2008, between direct written premium growth, this is all P&C lines in blue, and in orange is this year-over-year GDP growth. And you can see there's a pretty tight association between the two. The tight association kind of fell apart last year, not surprisingly, with the economy really diving. And you saw that what you see, however, is that with GDP growth shrinking, and then so what you have is direct written premium growth shrinking in blue, but not shrinking by as much. So the overall economy was down about 2.2%. Premiums actually grew by 2.2%. But it was a deceleration. So what will happen is we will be a little bit out of sync, but we'll have a resynchronization beginning, I think, in 2022, 2023, in terms of the relationship between direct premium written as well as GDP growth. So the relationship is directionally there, but just in terms of the magnitude of the difference of the growth, it was truly extraordinary last year. The unemployment rate has drifted down to about 6% in recent months. When we were at AIS last year, we didn't know it, but the unemployment rate in May was 13.3%. We had just gotten the numbers for April, 14.7%, which turned out to be the peak. We didn't know that. The expectation was that the unemployment rate could actually go up to as high as 20%. On a quarterly basis, you could see what's happened. During the second quarter of last year, we had an unemployment rate that peaked at 13%. That's well above what we saw during the financial crisis in the third quarter of 2009. So it was brief, it was terrible, but we are recovering much more quickly. So we are looking at 6% unemployment rate today. We're looking at an unemployment rate that will be around 4% by the end of 2022. That's the expectation at this point. But all of this reveals what I call the post-pandemic employment paradox. It's a tongue twister, I admit that. And there are jobs everywhere. Everywhere you go, it says help wanted. Some businesses can't even open up fully. My favorite restaurant cannot open up fully because not for lack of customers, but for lack of employees. Where have all the workers gone? Why are they sitting on the sidelines? Well, we saw millions and millions of people file for unemployment in the immediate aftermath of COVID. Not all that surprising. The largest numbers we had ever seen in history. We blew them away. In fact, we saw 6.1 million people file for unemployment in the first week of April last year. That blew away the previous records, which were close to 700,000. The most recent numbers we have as of May 1st, about 500,000 people have filed claims for unemployment that week. That is the lowest number we have seen in the COVID era. So people are coming back, but they're not coming back in the numbers you might expect given the availability of jobs. In fact, look at what's happening. We are seeing payrolls continue to rise. Payrolls, believe it or not, have now reached an all-time record high after plunging during COVID. We never would have expected that a year ago. Why? How did that happen, given that a lot of people remain out of the labor force? It's a couple of reasons. Number one, high-wage people, by and large, wound up keeping their jobs and actually wound up making decent money during the economic downturn. And now we're seeing lower wage jobs and intermediate wage jobs come back in that are propelling non-farm payrolls. But this is obviously the exposure base for workers' comp. To the extent that workers are hesitant to return to the labor force, this could actually slow the pace of exposure growth in workers' comp in 2021 below where we would like to see it. And so here you see the relationship between workers' comp net premiums written in orange, which are always more volatile. They're not only subject to volatility in terms of what goes on in the economy, but also in terms of what is happening in terms of the rate environment. So in workers' comp, the rate environment's been relatively flat in the last year or two. And so what we're seeing is wage and salaries, in other words, payrolls, rising and then flattening in 2020, whereas we saw workers' comp premiums written dive. And again, that's because of the loss of exposures, which is affecting workers' comp in a much more profound way than it is affecting the economy overall. So we'll move along from there. And again, just another reminder to be thinking about some questions, because there are some very, very interesting issues here. Okay, so what else is happening? Well, we see payrolls are increasing. Well, why are they increasing? Must mean more people are coming back into the workforce. That is happening. They're also getting paid more. So we've seen a lot of erratic activity in terms of average weekly hours. And so when you see hours worked plunged right in the immediate aftermath of COVID, or when COVID was getting underway, but it surged. So those people who kept their jobs wound up working more. They were working a lot of overtime. And in fact, what we're seeing is that the average weekly hours worked right now is the highest that we've seen in many, many years. It's an amazing recovery we've seen over the past year. So people who are keeping their jobs are working longer hours. All right. And good news, they're getting paid more. So we are starting to see some increase and some acceleration in the average hourly wage. You see that little blip there from last year. What happened was it looks like suddenly a lot of people were being paid more, but only a little while. That's because disproportionately job losses occurred among low-wage workers. So those workers left in the workforce were higher wage, so the average hourly wage of those that remained was higher. That is sort of starting to get, we're working the kinks out of that. And in fact, for the first time ever, the average hourly wage in the United States exceeded $30 an hour. We're seeing many companies announce that they are going to raise wages, not just Amazon's, but companies like McDonald's, for instance, one of the largest employers in the United States. So we're seeing those wage increases last year, nearly 5%, which is a very, very strong number indeed. But that being said, there are a lot of workers who are still, as what the government refers to as discouraged. These are people who claim to have searched for work so long in vain that they actually stop searching for work. And so we see today that there are still quite a few people who are discouraged workers. And we're going to have to work very hard as a nation to bring these people back into the labor force. So there were 573,000 discouraged workers, which is down from the peak of 700,000 last year, but still too many. Too many. We need those workers back in the labor force. So part of the problem here, you see it. The labor force participation rate really sums it all up. What you can see is that the labor force participation rate in April of last year, so basically shortly after before we were at AIS, plunged to 60.2%, the lowest number since 1971. It's since bounced back a bit to 61.7%, but it's still a miserable number. It is still far short of where we were prior to COVID. So you could see that there are millions of people missing from the labor force. Who are these people? If we take a look at the overall labor force participation rate in gold here, again, you see the 61.7 figure in April 21. You see for the male participation rate, it's 67.6, which is still well below the 69% or so what it was prior to COVID. And for women, it's at about 56%. No improvement last month at all. And again, that's below where it was in COVID, prior to COVID. So both are depressed, but there's been a lot of discussion about this particular recession that we've had impacting women more than men, in large part related to the fact that children have been out of school, had to study remotely, and that wound up falling to women disproportionately. If we even look at people in their prime working years, the ages of 25 to 54, when you expect virtually everyone who is to be able to be out there in the workforce, to be in the labor force, we could see that among prime or working age individuals, only 81.4% are actually in the workforce. That means nearly 1 out of 5 of prime working age workers are actually 1 out of 5 are actually out of the labor force, which is, again, a remarkable number. And again, this is about 2 points below where we were prior to COVID. How many workers are we short? This chart shows you in the yellow line, the gold line at the bottom for April, it says that we are still 8.2 million jobs short of where we were prior to COVID. But what it is also saying in the blue line is that the labor force is nearly 4 million workers smaller than it was prior to COVID. So we still have 4 million workers who need to be added back to the labor force. These are people who had jobs in February of 2020 who are not working today. That's why there are so many help wanted signs everywhere. That's partly why we are seeing some of the wage inflation that we are seeing. And in fact, the number of unemployed persons per job opening has shrunk to just 1.2 in March of this year. So basically, there's close to an equal number of people looking for jobs as there are jobs available. And so this is a big improvement from what we had seen in April of last year when there were 4.6 job seekers for every one available position. All right. So we did have a very disappointing labor market report from the Bureau of Labor Statistics on Friday. Just 266,000 jobs being created. The expectation is 1 million jobs were going to be created. So I'm going to now explain the post-pandemic employment paradox. All right. We've hinted at it quite a bit here. I'm going to summarize it. What do we have here? We mentioned we have a lot of people who have not re-entered the labor force. There are a lot of supply constraints right now in the economy. The U.S. is being held back not by lack of demand, but by the inability for supply to meet that demand. Many businesses, such as auto manufacturers, cannot fully reopen due to the lack of key components, keeping some workers sidelined. A lot of COVID concerns still on the part of some workers, lingering fears. Some workers are still fearful of returning to the workplace. Childcare issues. This is a meaningful problem. Only 60% of schools in the U.S. were open in late 2021, keeping some parents home, especially women, and keeping them out of the labor force. And we've heard a lot about this recently, financial disincentives, you call it couch cash. Approximately 50% of workers today on unemployment are making more than if they were actually back at work. In other words, the $300 weekly supplement that people are able to receive through September of this year actually is more lucrative than being back on the job. So we've heard a lot about that recently, and some states are trying to roll back those programs. We've even heard President Biden address this recently. Now, one of the very important issues that we were just getting a sense of last year at this time was the impact of federal stimulus programs. The government had begun to roll out early last year in March and in April a few programs, the CARES Act and other ones. Altogether, by the end of 2020, we had seen we had seen about 5. We had seen 5 different stimulus programs, trillions of dollars being spent. We had another one in March of this year, the American Rescue Act, and then we've had 2 more plans being proposed by the Biden administration, not necessarily directly related to COVID, but financially and in terms of economically would have similar sorts of impacts, an infrastructure plan and the American Families Plan. Well, as I mentioned earlier on, the legacy of all these, there are many legacies. It did help the economy. It did help the economy recover more rapidly than it otherwise would have. And so here we are. We've spent approximately $6 trillion at the federal level. These are just the federal COVID stimulus programs that have been approved to date, about $6 trillion. Essentially, all of that, as I mentioned earlier, has been deficit financed. So as I mentioned, so the debt is much higher than it used to be. But it's interesting to look at what the impact has been on workers of these stimulus programs. What you are seeing in red is the personal income for Americans, and you can see how it began to rise very sharply after the first stimulus programs came online in March and April of last year. We had another jolt in December, and then another jolt with the most recent plan in March. The blue line shows personal income for individuals less transfer payments. In other words, less the stimulus checks and any other sort of transfer payment they were getting from the government. What this shows is that people have been accumulating money in their bank accounts. And in fact, the savings rate in the United States is essentially higher than it's almost ever been. The savings rate in March of this year was 27.6%. Now, Americans aren't known generally for saving that much of their income typically, but their bank accounts have been swollen with these stimulus programs. So that is what's driving a lot of the economic growth today, but it's also what is keeping some people out of the labor force. So as I draw to a conclusion here, I want to discuss pandemic risk insurance programs. This was a big debate that began in the spring of last year. What role should the private insurance industry play during a pandemic? Many people automatically went to other programs that exist, such as the Terrorism Risk Insurance Program for inspiration, TRIA, or they even went to the Flood Insurance Program, places like this. And ultimately, from the perspective of AIS and from the perspective of everybody here today, should workers' comp be included in such programs? After all, it is included and covered under the Terrorism Risk Insurance Act. So the 6 fundamental questions that any pandemic risk insurance program has got to address. The first, how much should the private insurance sector, how much risk should it bear, if any at all? Believe me, there's not unanimity there. How much protection should the program provide? In other words, how much should businesses that are affected by future pandemics be able to receive? Should the government charge a premium for the risk that it bears? Why is that question even being asked? Because there is not a premium that is effectively being charged under the Terrorism Risk Insurance Program. Okay, should the purchase of coverage by businesses be compulsory? Should insurers have to offer the coverage? Should it be a mandatory offer, just like it is in TRIA? And should the program be bifurcated by firm size? In other words, different treatment for the smallest businesses in America versus the larger businesses in America, who might have more resources at their available to them. And at the end of the day, should workers' comp and general liability be included in these programs? So I'm just summarizing 3 proposals right here. Business Continuity Protection Program, BCPP. It's actually not insurance at all. This had a lot of industry support, although not universal industry support, where effectively what would happen is the claims-paying infrastructure of the P&C insurance industry would be used to provide what amounts to reimbursement for business income losses for businesses that were affected by pandemics. There would be some sort of declaration of a pandemic or some sort of parametric trigger, but this would be voluntary for both the insurer and the policyholder to participate in, which what that should translate as is probably a low take-up rate for the program. Okay, no workers' comp or liability included in this program. The Pandemic Risk Insurance Act, PRIA, modeled after the Terrorism Risk Insurance Act. This would require the industry to carry as much as $50 billion of potential liability on their own books through retention formulas. There would be no mandatory offer or no mandatory purchase. Again, no workers' comp or liability here included in this program, which differentiates it from TRIA. And then a number of carriers have proposals, as well as broker groups, where there would be certain types of coverages that would be tacked on to either workers' comp or to business interruption policies that would provide business interruption coverage in the event of a pandemic. There would also be a government-run pandemic reinsurer called Pandemic Re that would be established. Now, we could go on and on about these, and we could spend a couple of hours on these, but let me just summarize this way, because I think what has happened is that my assessment is that these proposals are probably going to go nowhere. Increasingly, there's a view that the issues arising from pandemics are fundamentally economic in nature, and they are of a magnitude that simply cannot be addressed by the private sector. In fact, are the appropriate domain of government and require massive government intervention. The government response to COVID, as we've already documented, includes trillions and trillions of dollars of fiscal and monetary stimulus, targeted programs, dozens of them, and marshaling government resources, something that no private insurer could ever aspire to do, nor would it be their appropriate role. So what would be an appropriate role for insurers? Sticking to their knitting. Insurers will best serve the interests of the country if they focus on managing insurable risks, preserving their financial strength, just as they did last year as they handled near record amount of catastrophe claims amid a global pandemic. You just take a look at these numbers, for instance. What this shows, these are estimated business interruption losses just for small businesses on a monthly basis. Anywhere from, depending on the assumption of what proportion of businesses have the business interruption coverage and what type of coverage they have, anywhere from about $52 billion to over $400 billion a month. You balance that against overall surplus of about $900 billion, and you can see it's simply not feasible. And in fact, overall business interruption losses for the economy, for businesses across the economy, are estimated at about $1 trillion a month during the height of COVID. And I've summarized a lot of this in a paper that I wrote last year. In fact, a series of papers. I won't run through this, but it is available from my website, or feel free to ask a question about this in a few moments during the Q&A section here. So last slide or two, best risk management practice. What has COVID taught us? It's taught us a lot. We have seen endlessly messages like this: cover your face, disinfect surfaces, social distance, wash your hands. We've seen this thousands of times. It's become instinct. We know what to do now. But what did we learn really now I'm looking at this from a worker perspective. From a worker perspective, if you take a look at what worked for those people who had to work during COVID and people are coming back, what drew them back into the workplace? Higher wages. That's one thing that's very effective. But also helping them feel safe with increased paid time off. Being paid for time when you have to recover from COVID-19, or even that you suspect you might have been exposed. Quarantine pay. Being able to work remotely. Companies spending more money on their health and their wellness. Childcare benefits, even benefits to help them get to and from a vaccine site. Workers have told us time and time again that these are the sorts of things that help them feel comfortable in the workplace during COVID. So the risk management lessons are being learned as we speak. All things considered, I think that the industry has, that employers have done relatively well, and that but we're going to have, and we're already having, a big discussion about what the government approach to risk management was. Time will tell. So that being said, the industry really remains strong, stable, sound, secure. We've avoided the worst case scenarios. A rapid economic expansion is underway, contributing to a surge of inflation. Yes, we'll have some asset price volatility, but at the end of the day, I think that what we are seeing today is manageable despite these ongoing business interruption issues. So with that, we have a couple minutes for some questions, and I'd like to invite the questions to come. Yes, so here we are. So we've got a couple of questions here, and so I'll summarize the questions and I'll answer. So first question relates to the specter of inflation. Could I elaborate on potential industry impacts, for example, such as medical costs? Absolutely. When you think about it from a P&C insurance industry perspective, obviously you think about workers' compensation, medical. You can also think about areas such as auto, where you have bodily injury and those sorts of things impacting it as well. I think that the immediate impacts, I've already hinted, are hitting the property lines right away and the auto lines right away. It's going to take a bit longer to seep into those lines that are more medically sensitive, however. A couple of other things. For instance, how concerned am I about the impact of rising inflation and dropping investment income on the P&C industry? To a very real extent, this is a refrain I've been uttering since the beginning of the financial crisis, when the Federal Reserve very aggressively brought down interest rates, and we saw the industry's ability to generate investment income suffer as a result of that. It never really recovered except for quite briefly. And now we're finding ourselves in that same situation once again. And again, the Fed has promised to keep interest rates low indefinitely. So I think if you're a chief investment officer at an insurance company today, you got your work cut out for you, because there's a lot of uncertainty in terms of where you're going to invest. Now, a few other questions. Geopolitical risks and their impacts on the economy. Yeah, there are a lot of those out there. And in fact, yes, you bring up the point. The ransomware attacks. Now, mind you, I had written that that risk before the ransom attack had even occurred. But the reality of it is that we as an economy are extremely vulnerable to supply chain disruptions. We are a just-in-time economy. We evolved that beginning in the 1980s. There's very little slack in the system. And so I think that whether it was toilet paper a year ago or whether it's gasoline today, I think that our vulnerabilities are manifest. And I think when you when you take a look at what is ailing this country today, we do not have a very robust structure in terms of maintaining our infrastructure at times of economic disruption or natural disasters or things like this, or some geopolitical issues that are occurring. And so we've got time for one more question, and I'll just respond to that. With the shortage of the labor force, do you think there'll be an acceleration of automation efforts? No question about it. One factor that I did not mention that is biasing us towards labor inflation ultimately is unfavorable demographics. And in fact, we've got population growth that last year, it was very slow, the slowest that we've seen in decades. So between the increase in the cost of labor, between the shortage of labor, and between the long-term demographics, there's no question about it that productivity is going to have to increase. And the way that that is going to increase is through automation and investments in technology. That isn't a bad thing. That isn't going to throw workers out of work. It, in fact, can make them more productive. And that is really the only alternative if this economy hopes to be able to continue to grow amid these very challenging times. So with that, I'd like to turn it back to Bill. Thank you very much for having me here.
Thank you, Bob. You're the one person in my entire career that can make 60 slides as interesting, as insightful as you did. And this audience loves having you at AIS, so thank you for being here.
Thank you.
Very
My
much
pleasure,
appreciate
Bill.
it.
Thank you very much.
Thanks.